Chapter 3: Bank Leases, Refinancing, and Repossession. Bank Leases and Refinancing. Unlike a traditional car loan, leasing is a type of financing in which the borrower pays for the use of a vehicle instead of the purchase of a vehicle. Leases can also be obtained through direct or indirect channels. A few banks act as leasing companies. To purchase an auto lease from a dealer, lenders and other financial resources express their interest by providing the dealer with the relevant terms of a lease similar to those considered for a loan. These terms determine the rent charge portion of the monthly payment and the length or term of the lease. In a lease, however, a finance source will also quote a residual value, which is the projected market value of the vehicle at the end of the lease. Auto dealers generally do not enter a financing or leasing arrangement with a consumer unless there is an indirect lender or lessor that will purchase the retail installment sales contract or leasing contract. With a standard lease, most of the monthly payment is the amount the vehicle will depreciate over the lease term, plus a rent charge. The steps involved in calculating the monthly lease payment are generally as follows. The consumer and the leasing company decide on the cost of the vehicle minus any trade-in, down payment, or rebate. As an example, let's say this vehicle costs $20,000. The consumer will decide on the lease term, which is typically 2 to 4 years. In our example, we will say 3 years, 36 months. The leasing company will determine what the vehicle will be worth at the end of the lease, known as the residual value. For example, $8,000 is the residual value. If the lease includes a purchase option, the residual value amount is often the purchase option price. The amount of depreciation is calculated by subtracting the residual value. For our example, $20,000 minus $8,000 equals $12,000 of depreciation. The monthly payment will be calculated by adding the estimated amount of depreciation during the term, plus the rent charge, taxes, and fees, and dividing that amount by the number of months in the lease term. In our example, $12,000 divided by 36 months equals a monthly payment of $333. Refinancing. Refinancing of an existing credit obligation can enable a consumer to reduce his or her monthly auto payment. The refinancing market is highly dependent on interest rates, so activity typically increases as rates decrease relative to the initial rate of origination. According to Experian Automotive, the average auto loan term was around 66 months for new vehicles and around 62 months for used vehicles. Market rates during the loan repayment period typically do not differ much from the rates at origination. These dynamics explain why overall refinancing volumes comprise only a small niche of the broader auto financing market.